Every economic crisis is explained the same way: bad policy, human greed, unexpected shocks. Yet there's a problem with that story. If mistakes caused collapse, the system would sometimes lose. But it doesn't. Nations fall, currencies die, citizens lose savings, yet the financial architecture survives, adapts, and often emerges stronger. So here is the uncomfortable mystery. What kind of money system keeps winning no matter what goes wrong? To answer that, we have to stop blaming events and start examining design. For most of human history, money was simple. It emerged as a tool to facilitate trade: gold, silver, tally sticks, commodity-backed notes. Money represented something real, scarce, and difficult to fake. Power came from production: land, labor, and resources. But scarcity created a problem for rulers. Wars were expensive, empires expanded faster than gold supplies, and raising taxes too aggressively led to rebellion. The solution wasn't more honesty, it was innovation. Enter banking. Early bankers discovered something revolutionary. Most people never asked for their gold back at the same time. This insight changed everything. Deposits could be lent out while still being available. Money could be promised twice. The seed of modern finance was planted. By the 17th and 18th centuries, governments formalized this system. Central banks were created not to protect citizens, but to protect states from their own spending habits. The Bank of England was founded to finance war. Debt wasn't a failure, it was a feature. This was the turning point. Money stopped being a neutral medium of exchange and became a policy tool. Currency issuance, interest rates, and credit allocation centralized into institutions that could expand money without immediate consequences. Cause and effect became delayed. Printing money didn't cause visible pain right away. Inflation arrived later. Debt piled quietly. Accountability dissolved, and most importantly, losses could now be socialized. Over time, the system refined itself. Fractional reserve banking evolved. Fiat currencies replaced gold. Governments borrowed instead of taxed. Central banks promised stability while quietly expanding balance sheets. Crashes didn't end the system, they strengthened it. Each crisis justified more power, more liquidity, lower interest rates, larger bailouts, bigger safety nets. When banks failed, they were too big to fail. When governments failed, they borrowed more. When currencies weakened, they printed faster. The system learned a crucial trick: privatize gains, socialize losses. No matter what happened, the structure survived. But cause and effect can only be delayed, not erased. Debt grows faster than productivity. Interest compounds faster than wages. Asset prices inflate while purchasing power collapses. Eventually, the illusion strains. History shows this moment repeating. Weimar Germany. 1970s stagflation, Japan's lost decades. 2008 global financial crisis. Each time, the diagnosis is different. But the disease is the same: too much debt chasing too little real value. And every time, the response is identical: more of what caused the problem. When the system protects itself, someone else absorbs the cost. Savers lose to inflation. Workers fall behind asset owners. Young generations inherit obligations they never voted for. Wealth concentrates not by productivity, but proximity to money creation. This isn't accidental. Those closest to new money benefit first. Those furthest away pay last and the most. The system doesn't collapse. It transfers. Every generation proposes fixes: regulations, stimulus, austerity, digital currencies, new monetary frameworks. But reforms target symptoms, not structure. Why? Because the system isn't broken, it's optimized. It's optimized to finance governments without revolt. Optimized to preserve financial institutions. Optimized to survive political cycles. Any reform that threatens this is quietly neutralized, delayed, or absorbed. Today, global debt exceeds multiples of global GDP. Interest rates rise, then fall. Crises accelerate. Emergency measures become permanent. Digital money doesn't end control, it enhances it. Transparency is promised. Surveillance grows. Stability is marketed. Fragility increases. The names change. The mechanisms don't. First, money is no longer just economic, it's political power encoded in numbers. Second, crises are not failures of the system, they are how it evolves. Third, the system doesn't need to be fair to survive. It only needs compliance. History doesn't show a system collapsing because people understood it. It collapses when reality forces change faster than narratives can adapt. The real question isn't whether this system will fail, but who will be prepared when it shifts again. If you want to understand money beyond headlines, beyond politics, beyond surface explanations, subscribe. Because the next crisis won't be new. It will be familiar,